Unlock the high returns of the expanding venture capital world right here on the Emerging Managers Podcast.
Welcome back. Scott Kelly, founder and CEO of Black Dog Venture Partners and your host for the Emerging Managers Podcast. And today, I interview Justin Cohen, the founder and managing partner of Collinear Capital. He discusses his venture capital fund, which focuses on enterprise B2B SaaS companies. The fund leverages a community of LPs who are highly connected in the technology, implementation, enterprise sectors to drive returns. He uses a mathematical model to predict future returns by connecting portfolio companies with their network of LPs who can facilitate introductions and channel partnerships. The fund targets on Series and Series A investments, co-investing with Tier 1 VCs, and aims to accelerate the growth of already proven companies. Cohen emphasizes that their approach mitigates risk by investing in companies with established product market fit and a clear path to acquisition to larger acquisitions. So give this interview a listen. I'll be back with some key takeaways. Well, hello, everybody. My name is Scott Kelly, the founder and CEO of Black Dog Venture Partners and your host for the Emerging Managers Podcast. And I'm excited to introduce Justin Cohen, the founder and managing partner of Collinear Capital. Justin, welcome to the podcast.
Hi, good to be here, Scott.
So just before we get into your fund, tell us a little about your background prior to launching the fund.
It's interesting. Everything in my background, I feel, is in many ways leading up to Collinear Capital. I started out as a physicist, and so very mathematically minded, and I'll explain the math term collinear later as to why we pick that. Yeah, very briefly, started out as a physicist. I was in high energy particle physics, so that's accelerator physics, and the birth of the web came out of accelerator physics. And I saw that I was right there when it happened. And I got really excited about the technology and the potential of it. So, within a year, I had left physics and started my first company. And one thing led to another. And I ended up having 4 technology companies. I believe the last one we sold to private equity about 7 years ago. And then they just sold it just in January as well. So, my background in many ways, besides being a physicist, is as an operator. That's really where I'm most comfortable. But for the last 7 years or so, I've mostly been doing VC, but I did a stint at Slalom Consulting, the consulting company, in their global strategy group, which was just a brilliant job. It was so much fun and sort of introduced me to the world of consulting, which ultimately led to Collinear Capital, because I left to do more VC stuff, but I came back to start the venture arm of Slalom Ventures. So I founded that and ran it for 3 years before leaving to do Collinear Capital, which in many ways is sort of picking up on that thesis and expanding on it.
Let's talk about this thesis. Talk about the types of companies you invest in, what you're looking for, your stage, check size, things of that nature.
So just to get the easy stuff out of the way, our first close is $25 million. So our check size is $2 to $3 million. So we're holding some back for follow on. We're investing at Series A, Series B. So we're not leading, obviously, any of those, but we're co-investing with Tier 1 VCs. The thesis is very much aligned with this sort of worldview that I learned when I was at Slalom. And that is that there are certain people that make enterprise work. Those are consultants on one side, right, that are helping these companies to implement new technologies, to understand best practices around new technologies, et cetera. And then there are their counterparts in the enterprise world, right? Those people at AT&T and Boeing and what have you, who are working to improve their companies. And this fund is very much for those people. So our LPs are people who work at these enterprises or at these consulting companies. I call them consulting companies, but really we're targeting the top 25 technology implementers, right? Those who understand how technology works with enterprise, right? And can drive returns at the enterprise. So those are the folks. We're not really like a clubby kind of in-crowd fund. We're very much like the math nerds fund, right? We're the people who we don't rely on a keen eye to pick like the right founder or something like that. We have an equation that drives returns for the fund. Basically, our community of LPs with their networks and their connections, we know 1,000 companies, right? 1,000 enterprise companies. We can make direct introductions to those companies. We can help set up channel partnerships at these very large technology implementers, things like that for our portfolio companies. So therefore, our portfolio companies have to be companies that work like that, right? They're enterprise B2B SaaS type of companies, often technology horizontals that can go across a wide range of industry verticals. Does that make sense?
Yeah, absolutely. I'm glad you mentioned the clubby thing. Yeah, we did this podcast based on the thesis of not talking to fund managers from Sand Hill Road, but so I appreciate that feedback. And you mentioned math nerds. Tell me how your background as a physicist helps you make portfolio company decisions and how you use that to help your portfolio companies post-investment.
Yeah, that's a great question, Scott. Actually, that's a unique question. I don't think I've ever been asked that before. So let's see. It actually is pretty clear. As a physicist, right, we've been trained to solve problems based on first principles. We don't look up the answer, we, figure it out. And that training makes you a bit of a skeptic in the world, right? So when someone says, "Hey, here's how, here's what I'm going to do," and your first question is how? Show me how you're going to do that. And I feel like a lot of funds today, it's all just sort of, well, you trust me. I've done this before. I'm in the club, right? Like you're talking about. And so honestly, I would never start a VC with that thesis. We needed to have, I'm doing this with a colleague of mine. She has a master's in financial math. She was a mathematician undergrad. So we're very aligned on this whole thing. Basically needed to be able to answer a question. When someone asks, how are you going to outperform, right? How are you going to drive fund returns? We have to have an answer that makes sense at fundamental principles, right?
Mhm.
It's not, oh, I believe, I can find a startup with grit, right? Like that's ephemeral. That's really hard to actually pinpoint and do from an analytical perspective, right?
Right.
But for us, we vet our LPs. We, work with LPs who are highly connected in the community. And then when we're looking at our portfolio companies and doing our diligence, one of the things that we do is we bring them to all of our LPs and say, how many connections do you have that would relate to this, right? So we actually build mathematical models. I know it's so nerdy, but we build mathematical models modeling what returns we would expect. And the way that we do it is very straightforward. Again, it's mathematical. We know that valuations are directly related to ARR, especially at these stages, not at super early, right? But Series A, Series B, it's straight multiple of ARR. And the multiple could change a little bit, but it's pretty much a linear relationship between ARR and valuation. So all we need to figure out is how much ARR can we drive to that portfolio company? And that we modeled that, right? Like the modeling is fairly straightforward. You look at your community of LPs, the connections that they have, the percentage chance of conversion of a connection into a sale, the average sale price, right? Like these are kinds of things that you can model. So we do these Monte Carlo simulations and we look at these histograms and stuff that are very Gaussian, by the way, and you get a result, right? Like, and you can pretty much predict what your funds are going to return on average. And that's the, the key there. We never know for
Right.
the individual, right? But you got to place your bets on the average. I would say that's how my background impacts the fund.
That's awesome. I have a couple of flashbacks just hearing you. My first flashback was when I was in junior high and my math teacher asked me to go up to the board and solve the problem as opposed to just, finding the answer on my calculator. So that was flashback number one. And then flashback number two, when I was in grad school, I was a GA to the finance professor, and he made me put together a modeling portfolio of the historical returns of every asset class, in the history of asset classes. So it's really intriguing that in the FOMO world of venture capital, you actually have a real applicable model to mitigate risk and make and maximize returns. So I really appreciate that. It's I was a math major for all of one semester, and I realized that wasn't my calling. So kudos to you. So Justin, tell me, how have you used this formula to have some success with the portfolio company? Any success stories you can share?
This is the first fund under this name. We did, however, when I was still at Slalom, we did put together a single SPV to test this model. And it was private. It was not related to Slalom other than having Slalom consultants as LPs. So we did test this out. And the results, I would say, were very, very encouraging, right? And led to the creation of Collinear. By the way, I alluded to this before. I should go ahead and mention the reason why we're called Collinear. And that is that for these kinds of partnerships that happen between the tech platforms and the consulting companies, everybody is financially incentivized to have this thing work. So the consulting company makes revenue from implementation, so they want it to work. The tech platform company, their valuation goes up if it works because there's new ARR coming in. Even the employees of the tech platform, like our portfolio companies, they're motivated because they all have stock options. So the valuation of the company goes up, they make more money. But typically, the folks who are actually making the partnership work, that is the consultants at these tech implementation companies like EPAM, KPMG, Cognizant, Infosys, all of those folks, they're just earning a salary. They never had the opportunity to generate returns based on their hard work of making this new partnership come to fruition. And so we've allowed these consultants and enterprise folks, the folks who actually do it, technologists, industry leaders, these are the folks that make these portfolio companies actually successful, but they never had any skin in the game. They never had any reward for their financial returns. They just earned a salary. And so now that they can be LPs in a fund that does this, their direct efforts drive returns. So it aligns them with everybody else. Everybody else was already aligned except for this group of enterprise folks, consultants and their partners on the other side. And so we've aligned that. And now everybody is collinear. So they're all along the same line in terms of financial rewards. Did that answer your question?
No, I really appreciate that feedback. And I'll go back to my other question in a second, but I want to talk about these consultants for a bit. So I would assume, and confirm if I'm right or wrong, that obviously these consultants have a vested interest. So they're probably very proactive in the go-to-market strategy for these portfolio companies, which obviously is of interest for them. Would that be the case here?
Yes. Now we have to be super careful about that. And the reason why we have to be careful about that is we want to make sure there's no conflict of interest.
Right.
Now, in the real world, we know that salespeople get spiffs based on what they're selling and all that kind of stuff. So, I'm not kidding myself about what's happening in the real world. But our role in these consulting companies is really one of awareness and education. So, for example, if you're an LP of ours and you're at a consulting company, we don't want you to go directly to a customer that you know through the consulting company and make an introduction there. What we want you to do is raise awareness within the company, let's say to the account folks who are running the account for some enterprise company and say, hey, I'm part of a fund that invested in this portfolio company, the startup. I think they would be really good for your client. Are you interested in hearing more? That way, the LP is never the person making a direct recommendation to a customer so that the customers only get information that's most beneficial to them, right? So you always have someone in between. However, on the enterprise side, right, we have direct customer connections and things which drive these returns.
And I'll back to the previous question. Maybe I'll ask it a little bit differently. So within the Collinear portfolio now, maybe talk your book a little bit. And who are some of the stars in your portfolio that you are either doing great things, have the potential to do great things?
Yeah. We don't make our first investment until end of the year. So this is a little bit premature. So we're still fundraising all the way through the year. And I'll talk about that in a second. But we have our eye on a company that we're very excited about. They're excited to be working with us as well. We know them from our Slalom days as well. It's a long history. And they are a technology company that uses computer vision and a 3D model of a system to understand where things are at any point in time in an environment. I know that sounds very, very general, but that's good for us because it applies. The use cases are across almost every single industry except for maybe in finance. But imagine this. Imagine you have a refueling station, okay? No, the gas station's got to get refueled, right? And they have these big tanker trucks that come and refuel them, but those tanker trucks need to be refueled as well. Generally, those are done by third-party operations where, ExxonMobil or Chevron or whatever don't have direct employees there. They don't have view to what's going on. And yet the standard operating procedures have to be monitored very carefully, or else you can get things like fuel leaks, explosions, like really, really bad things. So you need to make sure that the operators, first of all, are wearing proper protection. Secondly, that they're following these operating procedures down to the letter, right? So they're connecting the grounding wire first before opening the pump, and then they have the vacuum for vapor capture or whatever it is, right? But Chevron can't see any of that stuff. But there are these cameras there, generally security cameras, and they're not used. I mean, they're only used if something is stolen and they got to go back and, roll the tape and see who stole it or whatever.
Right.
So what this company does is, and it's a company called Worlds based out of Dallas, and they take the feed from these video cameras and they build a very straightforward, like sort of 3D model. And now, and this is going back to physics, they can build a physics engine to see exactly who's walking through, what's happening, where the fueling tanks are, and check for things like, are they wearing a hard hat? Are they connecting the grounding wire first before putting the vapor hood on? Like these kinds of things. And if there's a violation, they can do whatever you want. So it could be an email at the end of the day if someone's not wearing a hard hat, to shutting down the fuel line if the grounding wire is not connected before starting. And so this is just one example of what they can do with vision, right? But they're doing this using the same tool in Vegas. They have a gaming company that's watching people bet. And it is with a high resolution camera and again, a 3D model of what's going on. And they can see exactly who's betting what, when, and so forth. It's not necessarily for catching cheating. What it is for monitoring people's bets. So the pit boss doesn't have to try and estimate and count who are the high rollers. You can tell exactly how much anybody is betting at any given time. They do the same thing for food manufacturing, right? You've got tortilla chips that are going down the line. Sometimes they build up. So they have a very wide, and DoD work as well, oil and gas work, transportation. It runs across all of these industries, and we love that. We love them because, one, our LPs have connections across all these industries. Number two, somebody's got to build these 3D models and integrate it to the backend systems. And who are those people? Those are the tech implementers of the world. Those are the EPAM, the Cognizant, the KPMG, the Slaloms of the world, right? So it plays well with our community, and that's what we're looking for. And that would be a Series B investment. They're doing very well.
Awesome. So you mentioned that you're fundraising now. Share with the listeners. Let's talk to potential LPs and those that are recommending alternatives to their clients. So talk a little bit about the fund, just the background on the fund itself.
Basically, we have a parallel fund structure so that we can, it's the sort of an SEC requirement. We have our accredited investor fund, which we call our community fund. These are LPs that are small dollar amounts. Actually, our minimum investment there is only $25K. We don't really care how much people invest on that side as long as they have the minimum. The minimum is there so that they have skin in the game, right?
Sure.
That's the only reason. Otherwise, we don't care how much they put in, be $1. But those people, we want them because of their brains and their Rolodex, right? They're highly connected people. They understand exactly how these technologies fit into enterprise. So they make our thesis work. However, they don't have $20 million to spare, right? They're working people, right? And so we have a parallel fund, which is our so-called institutional fund. And that's really for family offices, consulting companies themselves, and so forth, that are providing the capital so that we can have, a reasonable stake in these companies. So We continue, actually, I would say we're doing a great job on the community LP side because that's where our focus is. These are our people, we are them, and we're gaining a lot of traction there, trying to diversify and get all 25 of the top tech implementers. We're making some really great headway there. I'll be in Houston this week, tomorrow, actually, and then Seattle. We're doing a big event there. That'll be super fun. And then on the institutional side, we're starting just now, actually starting to talk to family offices and things like that. And these folks, frankly, are interested because they get to leverage the value of our community LPs without having to do, the heavy lifting of that. They don't have to be highly connected people in enterprise, right? They're supplying the capital. Now, some of them are highly connected in the consulting space because they run consulting companies. And so that's great as well. But those are the two sides of fun. And they're required per SEC requirements to invest pro rata exactly in the same. So we act as one larger fund, but underneath the hood, it's two funds.
Understood. So I like to ask this question to all the VCs we have on the program because, in the vast, landscape of venture capital, there's only a handful of the monolithic funds you hear much about. So for our listeners that are LPs, potential investors, or managing assets for folks that invest in alternative funds like yourself, why your fund and why now?
Why our fund is easy to me. It's the only fund I'd invest in, I'll tell you. And the reason why, and I guess it's the only fund I am investing in. The reason why is the thesis is crisp and clear and makes sense. It makes sense logically. It makes sense mathematically. You can see how we drive returns. There is no trust me involved, right? So if you want to understand that, so I'm a big fan of Vanguard and indexed funds and managed funds, right? Like we're essentially a passively managed fund in the sense that, right, we're not picking stocks. We're not picking startups. Our startups that we're investing in are already have a proven track record, right? The companies that aren't really making it, product market fit wise, et cetera, they're gone by the time we invest. Of course, we, due diligence and we're investing alongside of tier one VCs and they're doing financial diligence, et cetera, right? But we know they're going to do well, right? All we're doing is accelerating it. So we've taken a lot of the risk out. So if you're looking for something that makes sense in terms of fund returns, and it's got good fund returns, like our Monte Carlo simulation is like 5x return. We don't know for any individual fund, but that's on average what it looks like for us. And you want to put it in something that is relatively low risk, right? Like we have good returns for investing in companies that are already well past sort of the early, we're getting, a lot of times these funds survive because they're getting a risk discount because they're going at right? And that allows them to get to, 25x, 50x or whatever on an individual investment. We're not going to do that. I promise you we're not getting 50x on our investments, right? Because our companies all follow a very similar trajectory, right? Series A, Series B, boom, they're sold to a competitor, right? They're sold to a larger organization, Oracle buys them or whatever. And the modeling on this stuff is relatively clear. So if you're someone who is maybe, more of a math person, more of someone who wants to understand exactly how the fund returns are happening, see the models, understand it, that's the fund for us. That's not for everybody, right? Some people want to be, in the club. You're not in the club with us, right? Like we are. Well, you're in the math nerd club, I suppose, but that's who our fund is for. And why now? We're the first to do this. We're the absolute first to do this. There's no other fund that does this. I was shocked when we came up with this idea. I looked and looked and looked. I thought it's such a straightforward model. Why hasn't it been done before? So let's get it done now and garner the returns that we can get before this market is saturated.
Fantastic. Any final thoughts you want to share with the listeners today, Justin?
No, Scott, I want to thank you very much for talking with me today. I'm super excited about the fund. I've got a bunch of travel coming up, which is always a delight because I get to meet so many people who are fired up at the fund. I get to meet a bunch of our LPs. So I would just say, hey, look, if you're someone who makes enterprise work, be on a consulting, tech integrator side, or in the enterprise side, technology, industry, reach out. We'd love to hear from you. We're always looking for top tier, experienced people who understand how technology fits into enterprise. And obviously, if you're a family office and you're looking for something that makes sense to you, let's talk.
Awesome. Where can they learn more about Collinear Capital and get in contact with you?
So they can go to our website, collinearcapital.vc, and that's Collinear. It's got two L's, surprisingly, COLLINEAR, capital.vc, or they can shoot me an email, justin@collinearcapital.vc.
Fantastic. Justin, again, thanks for being on the show. If you're listening in, make sure you follow, like, comment on this interview, and look out for more on the Emerging Managers podcast. Thanks for joining us, Justin.
Thanks, Scott. Pleasure.
Welcome back. And just to summarize and give some key takeaways from my interview with Collinear Capital, they really try to provide a thesis that's mathematically driven, as we mentioned, focusing on leveraging their highly connected LPs. So it's not just money that these LPs are investing, they're providing their relationships. And that provides a lower risk profile and predictable returns, And they want to make sure that the LPs have aligned incentives. Many of them are consultants and enterprise technologists that are financially incentivized to support these portfolio companies, creating the collinear alignment of interest. And, the parallel fund structure. It both has a community fund for accredited investors with a low minimum investment of $25,000 and an institutional fund for family offices and large consulting companies, providing many people an opportunity to invest alongside Collinear. And it's a target investment. It's enterprise, B2B SaaS companies, and in key industry verticals. You continue to emphasize the strong strategic partnerships. And this has been a theme, again, that we've had with many of our emerging managers, is that opportunity to provide more than just capital. It's introductions, it's mentorships, it's an opportunity to generate partnerships. And, I love the part they're really call it as math nerd approach. The value that the fund seeks are companies that can show a clear, data-driven path to success, aligning with their physics-based, first principles, problem-solving methodology. So, again, another great interview, and we've got more coming up, and continue to listen in, and I'll see you next time on the Emerging Managers Podcast.
Join Scott Kelly, Tracy Hazard, and their high-performing capital fund manager guests next week on the Emerging Managers Podcast. Don't miss our upcoming virtual and live VC Fast Pitch and podcast events. For more details, background on our guests, or an application to be our next guest, visit emergingmanagerspodcast.com. Don't miss out on shaping the future of venture capital and entrepreneurship with us by joining our robust community of innovators and investors today.